Welcome to another episode of the Profitable Home Services Podcast. Once again, I'm so glad that you're joining us today. I know you're busy. I know you're out there servicing your customers and your days are full. So thank you for taking a little bit of time and coming on the journey with us as we explore different topics each week and identify ways to plug those hidden profit leaks. Today, our guest is Ken Bohenek from Murphy Business Brokers, and we're going to talk about buying a business. I know that during tough economy times or uncertain economy times, businesses come up for sale possibly more frequently than they do when the economy's healthy. And I've heard from a few of my clients and coaching members that, hey, I want to buy a business. And I always caution them to stop. We need to run some numbers. We need to find out a little more about this business before we just jump in and say, I'll buy it. So I thought if I brought a business broker on our program today, we could explore the pros and cons of, first of all, of buying a business during this economy. And then what are some of the pitfalls, the dangers, the things that we should be watching for and paying attention to? How do we do some of that due diligence and those types of things? So hang on, fasten your seatbelts, and welcome, Ken.
Thank you, Diane. Appreciate the opportunity to speak with you and your listeners. I know that this is an important topic for many who are looking to buy a business, and there seems to be, no shortage of buyers in the market. And
Right.
we work with many. So as you described, we are business brokers, probably better termed as intermediaries. We are assisting both parties in the process of getting to the finish line, selling the business, but really helping both parties get there. So what we've noticed, for several years now, that many people, one reason or another, through their own desires that want to own a business, or somebody who has maybe left corporate America and has a skill set that they think would really help in terms of managing and guiding a business. Those are really kind of two of the traditional sort of individual buyers. We do work with other kinds of buyers, strategic corporate buyers. We work with private equity, smaller private offices. So we work with a variety of different kinds of buyers. But I think that maybe for this discussion, it's probably more in alignment with those that are maybe the single owner. We would consider them a financial type owner, maybe a husband or wife team that want to come in and take over. And so that's what I'm gonna talk to.
Yeah, what I see commonly with our clients and things that we work with, since they're in the $1 million to $25 million range, is they want to scale. And the quickest way to scale is go buy your competitor. And so we see this quite often is they'll pick up a smaller company to add to their existing company. And now we've just done a big step towards the scaling. So I think that's probably the most common one I see in my world is I need to scale. So why can't I just go buy Tom's business over there? He and I have been friends for a long time. He's got this great business. I just want to buy it. So why should they stop and put a broker in the middle or an intermediary in the middle instead of just Tom and I shake hands and pull out the old proverbial napkin and write up a little agreement. Here's the money and off we go.
Right. So that's what we would consider a strategic buyer, somebody that's trying to acquire somebody else. Anytime that there are two parties together, there are times that two parties, especially if there's a good relationship there, might be able to get it done. But there's also some benefits for each side. When you speak to strategic acquirers, there are certain adjustments to be made on the income statement, because there's going to be some benefits that are going to be there that for the buyer and the seller. Some of those shared expenses are going to fall off that income statement. And so understanding that process and making sure that both parties are aware of that Otherwise, sometimes one side could be benefiting more than the other. And what we want to do is see that there's some shared negotiation between the parties and understanding of where we're going and why this makes sense. From the front side, sure, it makes sense because how can I grow quickly? I can acquire my competitor and I get access to their revenue, their customer base, their employees, and bring that into my organization. There's also structuring things like structuring items that we would discuss depending on how that buyer is coming at the seller. So we're going to assist also on the structuring and make sure that there is, once again, that there's a process in terms of whether it's going to be a deemed asset sale, an asset sale, a stock sale, and there's going to be pros and cons of each of those kind of structures. So we would assist in that in terms of both parties and helping the buyer, because sometimes even the buyer doesn't know certain things are available. We have many lenders that we work with that specialize in business acquisitions. If this is going to be funded with SBA 7A type financing, or if it's going to be a combination of seller financing and what that looks like. So once again, we're going to help that buyer and the seller understand the pitfalls and the benefits to both sides of that. And there are certain benefits that are out there for a buyer that many buyers don't know about. If they are doing a true bolt-on, and how to acquire that maybe with 100% financing. So once again, we're in the market of doing this, so we're immersed in it daily, and that's why that buyer might want to come and say, hey, I'm thinking about, either I've identified a business, or how do we target some? Or typically the way that we're normally approached is that we already have one out there. Not all our listings are public, so some of them are private, the larger ones, and therefore a buyer developing a relationship with us gives them the opportunity sometimes to say, hey, if you have one of these, I'm looking to grow my concrete business or my excavating business, and I need, I want to find another target. Do you have anything? So that's oftentimes how we're going to get approached.
Very good. When somebody is looking at buying a home service business, does a seller traditionally get 100% of their money up front, or is the buyer expected to carry back some of those funds?
Or you mean the seller to carry back?
I'm sorry, yeah, the seller to carry back.
Yeah, no, that's fine. It really depends. Sometimes, depending on the deal, the buyer or the bank or both might want to have the seller stay involved.
Okay.
Comes back to structure again too. I mean, if we are doing a true exit strategy, and the seller is retaining a percentage of the corporation, and maybe they are going to stay on for 3 to 5 years and they're going to roll out their equity later, that's a little bit more of a complex situation as opposed to just a simple seller note. Sometimes the buyer will feel more comfortable depending on how much maybe seller goodwill might be in the sale, for the buyer to feel comfortable that there's shared success, I guess you could say, and the fact that if the seller is somewhat involved for a few years after the sale by virtue of a carryback, that seller's going to pick up the phone and answer a question or two when the time comes. The other is sometimes sellers are very comfortable with carrying some because of tax, deferring the tax, so that way it's considered an installment sale and not all of it is realized, because there are other things that go into how much, as you probably already know, how much they're collecting on that first tax year, and what that's going to look like from a tax perspective, especially, if we are talking a deemed asset sale or a true asset sale where there's going to be allocations made, and those are going to fall into different tax buckets. And that seller may say, you know what, I'm comfortable carrying 25, 30, 30% for a few years just to sort of defer that and get my adjusted, gross income and get out of that ordinary income tax bracket maybe a little bit. So yeah, there's a number of reasons that'll be done. And through due diligence and working with each, the buyer and the seller, we try to find out what's best for everybody.
I love that you just mentioned the due diligence piece of it. That's something I find is often lacking. Hey,
Hmm.
I've known Tom for 30 years now. Why wouldn't I just want to go buy his business?
Right.
But they need to sometimes slow down and do some due diligence. So what are some of the due diligence pieces that you would encourage a buyer to look at as well as a seller? Both of them are checking the other person out. Whether you've known them on a friendship or a surface level or not, you don't know how they're doing business.
Correct.
You might think you do, but you really don't. So how do you
Right.
how do you dig into that? How do you get that information?
So normally that due diligence process is going to be the follow-up piece to an accepted offer. Whatever that offer looks like, that's going to be it. You can say, hey, I know Tom seems like a great business. This is what I'm proposing to offer, but I'm going to, trust that it's great, but I'm going to verify through due diligence, right? So some of that, of course, is going to be just the financial vetting that you're going to see, because that's going to be typically what brings most people to the table. Hey, I know Tom, this seems like a great business he's had for 30 years, and this would be a great compliment to me. But maybe there's other things lurking that you don't really know about from the buyer perspective. And some of that could go away depending on this, once again, the structure. If it's a stock sale, any potential liabilities are gonna move forward under a stock sale, but an asset sale it won't. But depending on again, that pros and cons, you're gonna determine whether or not it makes sense. If there's a lot of contracts, if there's a lot of vehicles that need to be retitled, and there might be some liabilities hanging out there that you didn't know about. Well, maybe that's how you're gonna flesh that out and say, you know what, I'm not too worried about this accident that happened 10 years ago. It far outweighs right now the benefit to move forward with, let's say, a stock sale. So we're gonna guide both parties through that, and they're also their advisors, their tax advisors and whatnot. So we're not working just with one. We end up bringing in an entire group, right? We're working with both sides, especially when we're talking strategic. So we're going to guide them through that. They're going to want to poke some holes. Again, we're just talking from the buyer's perspective. They're going to want to poke some holes in certain things that, you know, what do their employee compensations look like? What are some of the some of their possible claims that they've had, whether it's general liability, workman's comp, any of those other items, and see what that looks like. Normally, the buyer is going to develop most of their list that they're going to send to me, that I'm going to pass off to the seller.
Okay.
Sometimes they'll come to me and say, hey, Ken, I'm thinking about, like, for one example, if we know it's a straight asset sale, it's really not worth a lot of time for the buyer to come and say, well, I want to see all their corporate documents. I want to see the registration with the state. I want to see their corporate minutes. Well, it's not really necessary to waste all the time and due diligence on that, because you're not buying the entity. So sometimes it's explaining to the buyer, this might be, you think that it might be important, but if you're not purchasing the equity of the company and the entity that it's tied to, it's really not really worth it, because you're not going to inherit any of those potential liabilities or the entity or the EIN or any of that. So again, helping them understand that portion of it.
Right. And I'm going to back up just a second for anybody who's listening. If you're not familiar with the terms a stock sale versus an asset sale, they're huge in my world, in the accounting and tax side. They're huge in Ken's world as well, because
Mhm.
it has everything to do with what you're actually getting. If you're just buying the assets of the business, that's what you're getting. You're getting trucks, you're getting equipment, you're getting stuff. You're not getting necessarily the name of the business. You're not getting that EIN number that's not going to roll forward. You're not getting those types of things. You are just getting just raw assets. And so there's a difference. There's reasons to do an asset versus a stock sale. And that's a topic for another day on the taxation side of all this. But in terms of just making sure that you feel comfortable as we're going forward and talking stock sales versus asset sales and those types of things. Back on the due diligence side, one of the areas I see is a real challenge is the systemization of a business and their software and some of those types of things. Sometimes the business that you want to buy may be ahead of your own business, which is probably a good thing, but other times they're lagging behind, especially if they've been owned by somebody for 30 or 40 or 50 years, and that person's not kept up with the fast moving pace that we're in right now with keeping software up to date or even having software. Some where we've run across a couple where they're completely paper and pencil and paper files and there's no
Mhm.
software to be had. Therefore, we don't have that nice, strong customer list and things that we are hoping for if we're doing a stock sale. Talk a little bit about that, Ken. How can we dig into due diligence and find out how strong is the business in some of these areas?
Right. And that's again where having somebody involved makes sense, because when you are poking those holes in as a buyer, you could be offending the other party because they don't understand the reasons that you're asking certain questions. And on the flip side, talking about customer names, you also have to be careful because it's a slippery slope. If you are going to expose who some of your customers are, you as the buyer may have assumptions on who some of their customers are, who you're trying to acquire. But that's got to be handled very delicately through due diligence as to when that's revealed and whatnot. So, and having that conduit between the buyer and the seller is sort of easing the any of the um, tension between the parties as to why certain things are being asked for. So I did
Mhm.
want to bring that up because that's oftentimes what happens is Tom and let's say Jerry, have been talking for 12 months, about, they've been trying to get through this deal, but it keeps hitting roadblocks and it stagnates and it's not getting done because the parties don't understand one another. They don't, why is Tom asking for this? And Jerry doesn't want to provide that. And you keep hitting roadblocks. So again, to keep it moving forward, and to your point, many times that buyer is more sophisticated than the seller is. So to explain what the buyer wants, what the buyer is looking for.
And I think sometimes the seller just plain doesn't have the information if they've not been keeping up and keeping their software current and all those types of things. And then it becomes a real stressor.
Correct.
That we,
Yep.
how in the world are we going to get this information that they're wanting? Plus, on top of that, they don't understand the reason for it.
Right.
And, I've had a couple clients hit those types of roadblocks, and it's like, okay, how are we going to scale this wall? We really need at least a general idea of the
Mhm.
data. We may not need specifics, but we need a general idea to know if this company will fit in with our existing company. We need to
Mhm.
dig into their culture. What's their culture like? Will it match our company culture?
Yep.
Because if it doesn't, you've got two different factions in a business and they start kind of fighting against each other instead of working together. And that's kind of like a marriage. You got
Mhm.
kids and I got kids and we get married and now we got two separate families and we got to somehow blend them together and make them one. A
Right.
business is no different.
Yeah, that's a very
And
good point.
that's where
Yeah.
that due diligence is so important. So you're not trying to blend two strangers and say, okay, A plus B equals C, and off we go. It
Right.
doesn't work that easily, oftentimes.
Yes, and the key component really in all of this is maintaining confidentiality, because not
Yes.
only for the parties that are working, together with one another, and also, controlling the flow of information between the parties, but then also, you know, vendors and staff and your employees, your customers, you don't know what you know yet. And you need to get to the point of where it's absolute before anything is really revealed. So it should be held in strict confidence. I think that there are there are those out there who think that they're doing a disservice by not letting their staff know that they're selling and whatnot. And really you're doing more harm than good, because as we're talking about assets, employees are probably the most important asset in the business. And that goes both ways. It goes for the buyer too. Sometimes the buyer may say, well, I want to sit down with upper management or these key people. Well, we need to handle that pretty delicately as to when
Oh,
we make
golly.
those introductions. So for the buyer and the buyer needs to understand that, because if the buyer backs away from the table and decides not to do it, and now key personnel know that the business is for sale. Now the seller is stuck with that and having to mitigate the risk there of possibly losing somebody, because if they really like working for Tom and Tom is looking to retire and they don't know, or maybe they don't like Jerry. And
They might not, right?
we've worked through that one before too, and it ended up being successful. But once again, if you don't know how to handle that properly, you could be like, and you as the buyer don't want to come in and have, 10 people leave.
No, no, that's the worst thing that could happen.
Right. So
Right. Yeah.
yeah,
So many different potential pitfalls when you're looking at buying and or selling a business from
correct.
either side, making
Oh,
sure
yeah,
that we've talked through these things and that the trust level stays there through the whole process.
correct.
Yeah.
Very true.
Well, as we were talking earlier, a lot of financial information is shared during this whole process. Now, up front, it's pretty vague, but then it starts getting more and more and more detailed, the further into the process we go. And I know from experience of working with home service businesses for many, many, many years, oftentimes there's a lot of, I'm just going to call it personal stuff, sitting in those books, sitting on those P&L reports, possibly even on the balance sheet. Sometimes, a lot of times I see the spouse's car sitting on the balance sheet as a note payable. Like, come on,
Mhm.
guys, that's not a business expense. It's on my depreciation schedule. There's a lot of that happens. How do we know as a buyer looking at somebody's financials, how do we know when they've been fluffed up and when they're really true and accurate?
Well, that's a great question. And what we've tried to do for years, and some of our clients come this way, and they recognize what we're trying to do for them. And that is, we number one, I guess probably the other thing to say is, one of the other things that we do at Murphy Business Sales is we also do a tremendous amount of valuation work of all kinds. And so leading up to that, what we want to do is we want to have that meeting with the seller early enough that we can clean up some of that, because the seller is going to have year over year, as you know, a tax strategy, right? But at
Mhm.
some point, planning ahead, if they do, which is what we ultimately desire, you can begin to shift that to more of a selling mindset and as a selling plan that you're planning to sell a couple of years out. The reason why I say that is because usually it doesn't happen that way. And one day you'll probably get a client in your office that says, I am ready to sell, right? But they've had a tax plan the whole time. So what we're going to do is uh, often the accountant has already, worked like you do, to kind of keep the books a little bit cleaner, if you will, a little bit less of the personal or discretionary expenses is what we call them. Some are okay. Some are discretionary in the sense of if you feel that from a charitable standpoint that you give back, and maybe you're $5,000 a year in charitable expenses, but maybe you're also gassing up the wife's car on the company card so that you could take that quote write off. Okay, because if your listeners understand or don't understand, one of the things that happens is, especially with pass-through entities, is that any of that excess income, that net income, is going to pass through to the taxpayer, and therefore most business owners want to be able to bring that down a little bit. We do what's called, normalizing of the financials, and recasting. And so there's what we call add backs. They could be positive, they could be negative, depending on what they are. And so we're going to analyze that income statement, and we're going to see that the items that are, normal and not excessive, that we can identify what they are and add those back. And what we're going to do is by doing that is we are going to take and get to what the true cash flow of the business is by identifying some of those perks, those add backs, and having that held out. That helps the buyer understand what has been added back and why, so that way the income statement makes a little bit more sense, and where the pricing of the business is going to fall. So we're going to work with them, once we, and really depending on how we're introduced into the equation, if we are working with two parties that know one another, and we're asked to step in and analyze that. Or if we already have a company for sale and the buyer comes to us, we're going to go through that process with them. That again kind of ties back into the due diligence side, because then they're going to want to dig into that a little bit more and say, like, I want to understand, some of these expenses that were add back that were personal. And while some people do that, some people don't. One of the things that most people don't know is that the the term SDE or these sort of add backs, most small businesses, even up to a few million, as they grow, they typically diminish some of those personal attributes, those personal expenses. But it's very, very common for there to be some overlap, because it can be difficult sometimes for a business owner to have it completely zeroed out, that there isn't any. Most of the times they're pretty clean, but if there is anything that does cross over, we want to identify those. We want to clean them up, make the business more presentable for the buyer's benefit, so they can see what's going on with the financials. Kind of clear the mud off the windshield a bit.
Well, now that we understand how the numbers are kind of put together, let's talk about pricing. And I'm going to act like I know nothing about this and ask you the question: is pricing based off of gross revenue? Is it based off of EBITDA, which is your earnings after or before interest and taxes and depreciation, just for those that are listening? Where do they set the price from?
Most always the price is going to come off a multiple of the earnings.
Okay.
And what happens is, because there's so many terms in this industry, people who are not familiar with it, and those are typically buyers, they'll have, and even sellers, they'll have heard a mixture of all different kinds of things. Well, I heard it's 1 times revenue plus assets. I've heard this, I've heard that. More often than not, it's going to be normalized cash flow, and then it's going to be analyzed for a certain multiple. And again, when it comes to business pricing, it's not 1 + 1 = 2, because you have to take into account other things. But just without getting into a complete discussion on valuation, usually the business should be valued at a multiple of cash flow, and that includes the assets. And so your assets should be creating the cash flow. So one analogy I usually like to say is, if you've got a trucking company and you've got $3 million in rolling stock out in the yard, and it's not out there on the road hauling, it's worth the fair market value of the rolling stock, and that's it. That's the only. But what we're going to look is, we're going to look at the assets, and then how much cash is coming in, and where they are in terms of their size, because you have SDE, which is seller's discretionary earnings, that will transition as a company grows in size, to where, and that SDE kind of ties back into some of those personal expenses that we were talking about. But as a company grows, gets more sophisticated, it has less owner involvement. Now we're going to start looking at multiples based on EBITDA. And so again, it's about the cash flow. And if that cash flow is strong, the value of the business is gonna far exceed the asset value of the business.
So one of the ways to keep our cash flow strong is to really pay attention to our receivables, our payables, structuring of loans. Occasionally, I'll see somebody buy a piece of equipment or a vehicle on a credit card,
Mm-hmm.
like it not good financing, not
Mm-hmm.
matched well with the asset. Just
Mm-hmm.
some of those types of things to be able to maximize that monthly cash flow,
Mm-hmm.
because cash flow and net profit are two different things.
Yeah, what a lot of people that I see, I getting back to that point, yes. It's great that you pay your vendors immediately as the seller, but you should be, but then sometimes I see where they wait too long to collect on their receivables.
Yeah.
And so their financial gap is out their ways. Well, the buyer, a good buyer, is going to want to know that, because that also impacts your working capital. So you should have a balanced approach to how you're collecting as the seller, and how you are paying, because sometimes it's okay to run up to 30 days before you pay your vendors. Your vendors are going to love it that you're paying so quickly, but you better be collecting on your receivables and shorten that financial gap. And that's kind of like to your point.
Right. That financial gap can vary from business to business. And I think sometimes they get busy and they're not paying as much attention to things like that as they need to be, especially if they're thinking they're going to be selling in the next couple of years.
Yeah.
How many
And
years?
sometimes it's also just the business that they're in.
It is
Sometimes,
too. Yeah.
sometimes if it is customary to be, 60 plus days out, but you're always collected on by 90, then that's okay. That's just maybe that particular business model and how you are able to collect with your customers. But oftentimes you can usually shorten that quite a bit.
Right. Correct. I was just going to ask you a question and it went flying
Sorry.
out of my head.
Sorry.
That's okay. Um, okay, I'll come back to that one later. Um, let's talk a little bit about financing, interest rates. If you're looking at buying a business, what are some of the things you need to be doing on your side? The seller's got a list of things they have to do, but you as a buyer have to come in clean and clear, able to get the financing. And so what types of things can they be doing so that when they are ready to buy a business, they're ready to buy a business?
Well, that's great because it's been a frustration here lately. And you know, we work with enough parties to know the ones that truly are ready to go. And just telling us that you're in a hurry and you want to go forward, and there are other hidden little components there that we can tell that you're really not ready. And one of which is we have been hit with a lot of people here in the past several months who claim that they have, quote, investors. And investors typically tend to be mom and dad who have some money that are willing to give their special child to be able to buy a business. And we're talking a little bit, we're moving away from strategic buyers a little bit. But it's an important thing to know. If you're a buyer who's going to buy a business, you should have cash ready to deploy on that and don't waste any time, because not to use the old analogy, time kills deals, but it does. And case in point, just to give you one pearl of wisdom here, is that you can have gifted money and buy a business, but if you wait to move that money and you decide that you're going to go ahead and buy this business using SBA funds, SBA is going to require that money to season for 60 days. So that's going to eat up 2 months just waiting on that. What I've said to other people is, and then sometimes what happens is, and we had this happen a couple of years ago where the money was supposed to be coming out of a trust. And I said, do you have, has there been authorization given that you can pull this money out? And they said, oh, yeah. Until it was time to pull the money out. And they
No.
said, no. We still got the
Oh,
deal
no.
done, but it took some time. But so, you take, if you're worried about it, you can still take it, put it in a high yield savings, somewhere that's allocated specifically for purchasing that business. You have quick means to it. It's still going to draw some good interest rate because you won't find a business overnight. Typically, it's going to take some time. So you need to be ready to go. If you should be ready to be able to provide certain things, like when we initially start to vet a buyer, we want to know a little bit about them so we can help them. Not because we're being probing, but because we want to help. Do you have means available? Just because you have $100,000 parked aside to buy a business, if you are using SBA, they don't want to see you use up all your 100,000. They usually want to see a little cushion. So maybe you're really going to have 75,000 or 80,000 that you could inject on an acquisition. So you should have cash ready to go. You should know what your personal financial statement looks like, and oftentimes really motivated buyers will just send it to us and say, here's my PFS, here's how much cash I have available.
Okay.
The last credit check that I did, my credit was 800, and will send us a snapshot of that. That tells us that they know exactly what they're doing to answer the questions that make them a very strong buyer for a business. And it makes it a lot easier when we make that initial introduction to the seller. Hey, this because they're going to want to know. And if the seller's later on looking at carrying some of this, that helps the buyer say to the seller, I am strong, solid, and I'm transparent, and I want to buy your business. And the seller then feels a little bit better about, like, okay, this is a solid buyer that I've been shown that can get through to this, and they're not being deceitful at all or holding back any information, because you're going to ask that seller to expose a lot of confidential information. So you as the buyer should be comfortable sharing your abilities, your strengths. And not only that, but maybe this isn't the best fit for you. Maybe we have something else that's even better. But we won't
Right.
know
Right.
until that. So
Yeah, I caution people often don't get your heart set on this particular business to buy,
yeah.
because you know, quite often there is a better fit business out there. You may
Mhm.
not know of it today.
Yeah.
And then also, as a potential buyer, making sure your books and records are clean, your tax returns are all filed on time, so that
Yeah.
you have that information to be able to share, that you've had a conversation with your banker, and you know that yes, you can move forward, and we're not doing all of this at the last minute. We
Right.
come in, yes, we're confident, we're ready, we've done our homework, we've got our finances in order. Some of those kinds of things makes for
Absolutely.
a much smoother process than, some of the stories you were talking about where months later you find out this person doesn't have the wherewithal to even begin to make this
Right.
purchase.
Yes. And again, we're working with you know, we're not saying you can't continue working with a lender that you have, but we're going to make introductions to lenders that we work with because they special in business acquisition lending. You don't have to give up your relationship if you already have one with the bank. This is a specialized lender that's gonna help you. They're gonna ask for these same IOs, and so having them available just makes the entire process easier. Not only that, but when we get to talking about any kind of seller financing and we're in due diligence, the buyer's doing due diligence on the seller, we're going to cross due diligence on the buyer. We're going to also ask for this, because when you ask the seller to finance a portion of it, they are now becoming the bank. And the seller, the guy that owns the concrete company down the street isn't a bank. He's a
Yep.
business owner, or a she. And so they need to feel comfortable that if they're going to finance a portion of this, that you are strong. So you as a buyer need to be really ready to go and be transparent and understand that when the early stages of when somebody like myself or another advisor comes in and asks these questions, they just need to know, because it's gonna get us there faster. It's gonna waste less time for everybody to make sure that when we make that introduction, we've got two parties who are at the early stages of finding out whether or not this is a good fit for them.
Right. Ken, this has been so amazing having you come in and talk about this from the angle of a buyer. I know that you would much rather have talked about from the angle of a seller, but buyers are just as important, because without buyers, we don't have sellers.
We don't have
So,
sellers, correct? Yes.
right. So thank you for doing this.
You're
Now,
welcome.
as this podcast is all about finding hidden profit leaks, can you share a hidden or unique profit leak that you've seen as you've worked with buyers and sellers where they've left money on the table?
Not understanding how the business is priced is probably the key component to this. You may not understand the differences between strategic add backs and add backs, so that could certainly impact some value. And you might be thinking that you're doing yourself, or your friend down the street who wants to buy your business. But you put in a lot of work into building that business. So there needs to be benefit on both sides. But I would say making certain that it's priced properly. The buyer could end up overpaying for something by having a person represent a business that is not priced accurately. So that's on the buy side, and then the seller, on the selling side, just making sure that they're obtaining the correct value of the business. And so we are often setting expectations as our number one, probably the number one thing that we do is set expectations, whether it's good or bad, for both parties.
Well, because as the seller, we always think our business is worth a gold mine. And as the buyer, it's worth a pile of dirt until you
Yeah.
show me that it's actually worth a gold mine. So, yeah,
Hmm. Yeah.
two completely different angles that they come at. So
Yeah,
Ken,
and really from the sell side, I think that the other thing is plan ahead. And not only that, make sure that there are certain things that are there. If you own the building outright that you're in, the company should still be paying itself lease. We're going to put it in there, make sure that you're maintaining profit margins, make sure that, that you're watching your pricing, right? Because over the past few years, there's been a lot of shrinkage in margins for those who have not stayed on top of it. And it's hard to claw that back later. So
right, yeah. Well, thank you so much for coming on the program today and just sharing your wisdom. I know you've got many years of working with businesses from both sides, so I appreciate you
you're
being
welcome.
willing to come in and talk about this because I know that these home service businesses, they have questions and they don't always have somebody they can go talk to about it, or at least somebody who's going to give them a better answer than just their neighbor or their barber or their whoever that they've
Right.
actually talked to it about.
Yep.
Yeah, so thank you for coming on and helping us understand this process a little better.
You're
And
welcome.
where can where can our listeners find out a little bit more about Ken and Murphy Business?
So you could go to Murphy Business CDA, the short acronym for Coeur d'Alene, .com. We'll take them to our page. We have there's a couple of agents here, advisors in my office in Coeur d'Alene. We have a transaction coordinator here as well, and then the rest of our team down in Boise. So you can go to murphybusinessboise.com and find out. Actually, either one is going to point you to that. We give it. You can sign up on there if you want to receive a monthly newsletter that's going to ping you on any new businesses that are coming out. And there's also, I think, a blog on there to be able to find some generally frequently asked questions. And then all our contact information is there as well.
Okay. And if somebody's outside of this area, because I know I have listeners all across
Mhm.
the US, you guys are able to point them in the direction of a broker in their area.
Correct. Yeah. And I've worked on deals in several other states. But that's one of the things that makes us fairly advantageous is that we have a national reach. We actually even have offices up into Canada. If I can't help with a transaction in another state, I usually have a colleague that I trust that I can put that buyer or seller in contact with, that I know will get the deal done.
Great. That's one of the reasons I reached out to you instead of a couple of the others that I've come in contact with, because I know you guys have such a reach across the country.
We do, and we have a great internal forum for helping one another, and it's a great organization. It's why we're pretty much the best one out there. Is and probably just offended somebody that's a competitor, but we are the best at what we do. We have a very high closing ratio. We do a lot of large deals, and there's a reason why a lot of people come to us looking to buy a business or to sell one.
Well, thank you again, Ken. I'm so glad you joined us today. And for those of you listening, I'm hoping we've answered some of your questions. If you still have a burning question, reach out to us. And we're happy. I'm sure Ken would be happy to hop on a call. I'm happy to hop on a call and see if we can get your questions answered. And if you are looking for a business, by all means, reach out to Ken. Or if you're looking to sell your business, reach out to Ken. I'm sure he can help you. And so we're going to say that's a wrap. Thank you so much for joining us, and we'll see you on the next episode of the Profitable Home Services Podcast.
Thank you, Diane.